The headlines aren't telling you this, but something dangerous is brewing beneath America's housing market. It's not just high interest rates, not just inflation. It's the silent collapse of the US dollar's purchasing power. And it's about to hit certain states like a financial earthquake. Across the country, builders are stalling projects. Homeowners are watching their costs skyrocket. Investors are quietly pulling out. Why? Because as the dollar weakens, the real estate game changes, fast. Think about it. If the materials to build a house cost more, if wages don't keep up with inflation, if insurance becomes unaffordable, who's going to keep buying at today's prices? But here's the twist. Not every state is equally exposed. In fact, some are sitting on a ticking time bomb, where just one more slip in the dollar could trigger a full-blown real estate correction. So in today's video, we're counting down the top 10 states where dollar devaluation will crush real estate market in 2026. Some of these may surprise you. Others? You'll wish you sold months ago. Stick around, because if you own property or plan to invest, this list could save you from making a very expensive mistake. Comment below. Which state do you think is most at risk if the dollar keeps sliding, and why? And don't forget to like, subscribe, and turn on notifications as we dive in. Number 10. Nevada. They say what happens in Vegas stays in Vegas. But what if what's happening is a full-blown real estate fallout? Nevada has long been the land of illusion. Bright lights, big casinos, and booming suburbs that seem to rise overnight. During the pandemic, Las Vegas saw one of the fastest housing recoveries in the nation. People from California and across the country poured in, hunting for affordable living and investment opportunities. Prices soared. Builders expanded rapidly. But as the dollar weakens, the foundation beneath this fragile desert economy begins to shift. A weakened dollar means higher costs for imported materials. Cement, steel, appliances, all essentials in Nevada's construction-heavy housing economy. The state doesn't manufacture much of its own materials, making it heavily dependent on out-of-state or international supply chains. That spells disaster for affordability and new development. Tourism, the lifeblood of Las Vegas and much of the state, also takes a hit. A weaker dollar hurts discretionary spending across the board. Domestic tourists tighten their wallets. International visitors, who once found Vegas a relative bargain, begin looking elsewhere. And when casinos feel the pinch, so do the workers, the landlords, and the entire housing ecosystem. What makes Nevada particularly vulnerable is its dependency on service sector jobs, many of which are sensitive to inflation and market shocks. With wages stagnating and consumer prices soaring, even longtime residents are being pushed out of their neighborhoods. Vacancy rates are beginning to tick up. Developers are pausing projects midstream. Number 9. Arizona. There was a time, very recently, when Phoenix felt unstoppable. People were fleeing California in droves, cashing out on sky-high homes and planting roots in Arizona's red-hot real estate market. Phoenix, Scottsdale, and surrounding suburbs became ground zero for what some called the Great American Migration. Homes that sold for $280,000 in 2019 were going for over $480,000 by 2023. But now, the sunshine is starting to scorch, and not in the way buyers hoped. Arizona's real estate story was built on one fragile assumption, that growth would never stop. But in 2025, the dollar's decline is rewriting the script. A weaker dollar means imported goods cost more, and Arizona's housing sector is heavily reliant on out-of-state materials, tiles from Mexico, lumber from Canada, even HVAC systems from Asia. It also means inflation eats away at wages, and suddenly, those middle-class buyers who were once flocking to Phoenix can't keep up. The result? Inventory is rising, price reductions are happening quietly, and investor demand is starting to taper. Even worse, Arizona is now grappling with surging climate insurance premiums. Wildfires in the north, heat dome warnings in the south. As the cost of insuring a desert home becomes less predictable, lenders grow wary, and so do buyers. For a state that was booming off the back of affordability and migration, the double punch of inflation and devaluation spells a harsh reversal. Now ask yourself, if people came to Arizona looking for affordability, what happens when that affordability disappears? Number 8. Colorado. Colorado used to be where dreams touch the sky. Snow-capped peaks, clean air, tech innovation, and real estate that felt like a golden ticket. From Denver's bustling tech corridor to Boulder's elite college town appeal, the housing market here once thrived on endless demand and sky-high appreciation. But now, that dream is teetering on the edge of a financial cliff. A weakening US dollar doesn't just mean more expensive groceries or gas, it means a total reshaping of housing economics. In Colorado, where building costs are already among the highest in the nation, the impact is seismic. Nearly everything involved in constructing a home, steel beams, roofing materials, plumbing fixtures, is sourced from outside the state or even overseas. When the dollar devalues, those imports become more expensive overnight. Builders now face impossible math. Developments in areas like Colorado Springs or Fort Collins that once promised healthy returns now sit stalled or half-completed, victim to ballooning costs and crumbling demand. And then there's the affordability crisis. Even before inflation, Colorado's home prices had already outpaced wage growth. With inflation now surging and the dollar weakening further, families are squeezed harder than ever. Middle-class buyers are increasingly priced out, forced into renting as property taxes and insurance costs climb alongside the CPI index. Meanwhile, second home demand, once a stronghold in mountain towns like Aspen and Breckenridge, is cooling. Wealthy out-of-state buyers, facing currency risk and broader market instability, are pulling back. That leaves overpriced listings sitting for months, collecting dust in markets that used to sell in days. And here's the chilling forecast. If the dollar continues its downward trend, expect a domino effect in Colorado: stalling development, population stagnation, and declining home values in areas that once felt bulletproof. The Rocky Mountains haven't moved, but the financial ground beneath Colorado's housing market definitely has. Number 7. Georgia. Atlanta once wore the crown of affordability in the South, a city bursting with culture, opportunity, and spacious homes that didn't break the bank. But today, that promise is fading, and fast. As the dollar's value shrinks, Georgia's real estate market finds itself at a dangerous crossroads. A few years ago, homebuyers were lining up in metro Atlanta suburbs like Marietta and McDonough, lured by the dream of bigger homes, lower costs, and a booming job market. But that dream is now colliding with harsh economic reality. The weakening dollar has unleashed a chain reaction. Inflation is up, mortgage rates are volatile, and construction costs have exploded. Builders across Georgia are sounding the alarm. Lumber, wiring, HVAC units, so many of the critical components of modern home construction are imported or priced in relation to global markets. And when the dollar weakens, those prices skyrocket. Some projects are being postponed, others are being canceled altogether. Meanwhile, the everyday buyer is caught in the middle. While Atlanta's tech and logistics sectors continue to grow, wage gains simply aren't keeping up with housing inflation. In fact, many prospective homeowners now find themselves priced out just months after getting pre-approved. Even renting is getting expensive. And here's the silent killer. Property taxes and insurance premiums are rising quietly, especially in rapidly gentrifying neighborhoods. What used to be a safe haven for middle-income families is becoming a financial trap. Georgia's urban boom was built on the promise of accessibility. But what happens when inflation, construction bottlenecks, and a weakened dollar strip that promise away? If the trend continues, expect buyer fatigue, longer days on market, and a growing divide between high-income earners and everyone else trying to keep up. Atlanta may still be growing, but the ground beneath is shifting. Number 6. Florida. For years, Florida was America's escape hatch, a sunny tax haven where retirees, remote workers, and investors all found their slice of paradise. From Tampa Bay to Naples, Orlando to the Panhandle, homes were snatched up like beachfront souvenirs. But in 2025, the storm clouds are gathering, and not just meteorologically. Florida's real estate boom is colliding with something far more dangerous than a hurricane: a weakening US dollar. And this time, the damage won't just be physical, it'll be financial. Let's start with insurance. Florida already had some of the highest homeowners insurance premiums in the country, thanks to intensifying hurricanes, rising sea levels, and an increasingly fragile insurance market. But now, with inflation driving up construction and repair costs, insurers are pulling back or jacking rates sky high. And with the dollar weakening, Everything, from imported roofing materials to labor, costs more, making it even more expensive to rebuild, remodel, or simply stay insured. Then there's the migration story. Millions moved to Florida post-pandemic, driving demand through the roof. But many came on fixed incomes, especially retirees. Now, with the dollar's purchasing power dropping, their savings don't go as far. That dreamy Florida retirement is suddenly looking a lot more stressful. Construction is also under siege. The state imports a large amount of its building materials. When the dollar dips, supply costs explode. Builders halt projects, housing stock stagnates. Prices remain high, but fewer people can actually afford to buy. Even international buyers who once scooped up condos in Miami and Sarasota are hesitating. With the dollar's value in flux, currency risk becomes a factor. And with luxury demand slowing, prices could see sharp corrections in once red-hot markets. Here's the question Floridians and investors should ask. Is the Sunshine State becoming too expensive to live in, even for the wealthy? Florida is still paradise. But in this economic climate, paradise might come with a price tag that no one is ready to pay. If you have been following this countdown attentively, drop a comment below. Which state do you think is at the biggest risk if the dollar keeps sliding? Let's talk about it. Hit the like button and subscribe to the Globe Realty. It helps us reach a wider audience on our weekly updates on real estate across America and around the world. Let's continue. Number 5. Washington. The Washington state, home of billion-dollar tech giants, evergreen forests, and some of the most sky-high housing prices in the Pacific Northwest. But in 2025, that skyline of cranes in Seattle is starting to freeze. And the culprit? A weakening US dollar that's putting unprecedented strain on a market already on the edge. At first glance, Washington seems untouchable. Massive tech employers like Amazon and Microsoft keep the economy buzzing. But dig a little deeper, and you'll find the cracks widening. Let's talk construction. From Seattle to Tacoma, the region has long faced a housing shortage. Builders scrambled to meet demand, but Washington relies heavily on materials from out of state, and many are imported. With the dollar declining in value, every load of drywall, every steel beam, every imported finish now costs significantly more. Construction budgets are being blown. New developments are slowing. Meanwhile, those cushy tech salaries aren't spreading as far. Inflation is eroding purchasing power, and layoffs in the industry have already cooled demand. Suddenly, the bidding wars are gone. Homes are sitting longer. Prices aren't crashing, yet, but the market is shifting. Then there's property tax. Washington has no state income tax, which sounds great, until you realize that property taxes often make up the difference. As home values soared over the past decade, tax bills followed suit. Now, with inflation biting and maintenance costs rising thanks to a weaker dollar, many homeowners are getting hit from every side. And foreign investors? Washington used to attract heavy interest from international buyers, but a volatile dollar makes investing less predictable and less appealing. That leaves high-end condos and luxury homes vulnerable to sharp price drops. The truth is, Washington's market has relied on confidence. But when inflation spikes and dollar devaluation shakes that confidence, even the strongest tech-fueled cities can start to stumble. Number 4. California. For generations, it was the ultimate destination. But in 2025, even the Golden State can't outrun the cold reality of a shrinking dollar and surging inflation. California's real estate market was never for the faint of heart. In cities like San Francisco, Los Angeles, and San Diego, million-dollar price tags are slapped on homes that in most other states wouldn't fetch half as much. But that dream is starting to fracture. Why? Because a weaker dollar changes everything. First, let's talk about construction. California is notoriously expensive to build in, even without inflation. Add a devalued dollar, and you get skyrocketing costs for materials, most of which are sourced from out of state or overseas. Lumber, tile, glass, copper wiring, all now cost significantly more. Builders are slowing down or stopping entirely, especially in lower-margin affordable housing projects. That's bad news for a state already suffering a severe housing shortage. Then there's the regulatory burden. Permits, zoning delays, and environmental compliance already add massive costs to any project. When those are combined with higher material and labor prices, the feasibility of new development collapses, especially for anything remotely affordable. On the demand side, middle-class Californians are fleeing. They're tired of competing with cash-rich investors, tired of $8 lattes, and tired of spending 60% of their income on housing. With inflation eroding purchasing power and interest rates remaining high due to economic instability, many simply can't buy, even if they want to. And here's a twist. Foreign investors, once a major driver in markets like LA and the Bay Area, are pulling back. A volatile dollar introduces too much risk. Without their capital, luxury properties, especially in San Francisco, are facing prolonged listings and price cuts. California may still be the land of opportunity, but the gap between the dream and the reality has never felt wider. Number 3, Texas. A state where everything felt bigger. Opportunity, square footage, investor returns. Austin became the new Silicon Valley. Dallas and Houston exploded with new developments. Land was cheap, taxes were low, and builders were working around the clock. But now, that Texas-sized boom is facing a reality check, thanks to the devaluation of the US dollar. Texas attracted massive interest because it was seen as affordable and investor-friendly, but affordability has taken a nosedive. Home prices in Austin more than doubled between 2020 and 2023. Now, with mortgage rates elevated and inflation pushing costs up across the board, buyers are pulling back, and the cracks are showing. The devalued dollar is making building more expensive. Texas may be big on domestic production, but construction still relies on national and global supply chains. Everything from HVAC systems to electrical components to roofing materials. A weaker dollar means imports cost more. Builders are squeezed, margins shrink. Some projects in the outer suburbs of San Antonio and Fort Worth are on hold indefinitely. Then there's the property tax problem. Texas has no state income tax, but in its place are some of the highest property taxes in the country, and those taxes are tied to soaring home valuations. As inflation kicks up and wages lag, thousands of homeowners are finding themselves house-rich but cash-poor, stuck with rising tax bills they can't afford. Insurance? It's not much better. Hail, floods, hurricanes, all are driving premiums sky-high. Some companies have pulled out of Texas entirely. That means limited options and outrageous rates, especially in coastal and storm-prone areas. Investors are now growing cautious. Institutional buyers that once scooped up homes in bulk are scaling back. Rent growth is slowing. Days on market are increasing. Texas still has land. It still has jobs. But the narrative of unlimited growth has collided with the new reality. A weaker dollar, higher costs, and a market trying to catch its breath. Number 2, Hawaii. The dream. The postcard, the fantasy. For decades, it symbolized peace, prestige, and prosperity. Ocean views, island breezes, and million-dollar condos dotting the coastline. But in 2025, that postcard is beginning to fade. Behind the paradise lies an economic pressure cooker, and the flame just got hotter with the devaluation of the US dollar. Let's get one thing straight. Hawaii imports nearly everything. Food, fuel, lumber, drywall, appliances, even labor in many cases. And when the dollar weakens, those imports cost more, a lot more. So imagine trying to build a home on Oahu or Maui today. The cost of materials has surged, shipping fees have doubled, construction timelines are delayed, if not abandoned, developers are retreating, small contractors can't keep up. The luxury boom? It's wobbling, and everyday locals, already priced out of their own state, are watching housing affordability slip further and further out of reach. Hawaii has long depended on a unique blend of foreign investment and tourism-driven demand. But a volatile dollar creates hesitation. Global buyers are now wary of dumping millions into property whose currency value could swing wildly. And as inflation erodes disposable income across the board, domestic tourists are pulling back. That means fewer short-term rentals, shrinking Airbnb income, and less rental ROI for investors. And for locals, it's even bleaker. Median home prices remain north of $800,000 in many areas, but real wages haven't moved. With inflation rising and the dollar weakening, household budgets are stretched thin. Many are now being forced to leave the islands altogether, accelerating a trend of outmigration that's slowly changing Hawaii's social fabric. And here's the hidden threat. With climate risks increasing and insurance markets tightening, more homeowners are being hit with soaring premiums or dropped altogether. That condo with a view of the surf? It may soon come with a 5-figure annual insurance bill, if you can get one at all. Number 1. New York. The financial capital of the world, the city that never sleeps. The Empire State where real estate was once king, glittering penthouses, soaring towers, townhouses worth tens of millions. But in 2025, New York isn't rising, it's reeling. And a weakening US dollar may be the final blow that cracks its already fragile foundation. Let's be clear, real estate in New York has never been cheap, but it's always been global. For years, investors from China, Russia, the Middle East, and Europe poured money into NYC properties, not just for returns, but for stability. But now, as the dollar loses value, that stability is gone. Currency risk, economic volatility, and rising inflation have foreign buyers reconsidering. Deals are falling through. Interest has cooled. The luxury market, especially in Manhattan, is already flooded. Billionaires aren't bidding. Penthouses linger on the market. And new developments are being shelved as costs soar. Why? Because building in New York is brutally expensive, and most of it depends on imports. A weaker dollar means every imported tile, every elevator component, every inch of Italian marble now costs more. A lot more. But the pain doesn't stop at luxury. For everyday New Yorkers, the outlook is even more troubling. Property taxes are among the highest in the nation, and many are indexed to inflated property values. As inflation pushes up the cost of everything, food, utilities, transit, those tax bills become unbearable. Meanwhile, landlords, especially small ones, are trapped. Rent control laws limit what they can charge, while expenses spiral out of control. And don't forget maintenance. The city's iconic pre-war buildings, they're aging, fast. Roofs, boilers, facades, all need repairs. But with material costs soaring due to a weakened dollar, upkeep becomes a financial nightmare. Many co-op boards are now issuing massive special assessments just to stay afloat. Add in rising insurance costs, aging infrastructure, and a wave of commercial office vacancies post-pandemic, and what you have is a slow-motion collapse of confidence in New York real estate. So here's the chilling question. If the dollar keeps falling, can the Empire State afford to hold the crown? Or is the empire already cracking beneath its own weight? From Hawaii's paradise to New York's penthouses, the weakening US dollar is not just a macroeconomic footnote. It's a real and present threat to homeowners, investors, and developers alike. While some markets may adapt or even thrive, these 10 states are standing on shaky ground. What do you think? Are we heading into a quiet collapse or a full-blown correction? Drop your thoughts in the comments. And if you found this video insightful, like, subscribe, and share with someone who's eyeing the housing market in 2026. Until next time, this is the Globe Realty, helping you navigate the world of real estate, one trend at a time.